day, everyone. Thank you so much for joining us today for our economic briefing. And for this briefing, we want to review over the performance of the Community Bank Benchmark Group for the first quarter of 2020. And a lot has gone on this quarter. We know that the coronavirus has impacted all of us, and I hope that everyone's doing well. We're starting to see things opening back up. Been talking to a couple of banks across the United States who are beginning to open their branches once again to foot traffic. So as things open up, we hope that the economy will recover fairly quickly, and we'll talk a little bit about that in a future webcast. So for today, like I said, we want to focus on the performance of that Community Bank Benchmark Group. And just a reminder that that benchmark group includes banks with assets between $100 million and $5 billion. And as we can see, the return on average assets has come down over the past couple of quarters, reaching that high of a 123 back in the third quarter of 2019, pulling off down to a 1% for this quarter, the first quarter of 2020. And we know that with just 2 weeks built in, 2 weeks of the shutdown built into last quarter, we know that the full impact will not be seen until later quarters. So we anticipate that number to come down. Looking at the different components of ROA, we have the three subgroups that we look at. The sub S gaining 1.37% in terms of return on average assets. And we see the stock group coming in at just under 1 at 0.93, and the mutual institutions coming in at 0.42. So we see similar trends across the board in each of those areas. We look at net interest margin. 80% to 85% of a bank's revenue is produced in net interest margin. And when we look at this, we can see it continues to come off 3.68 for the first quarter, and we anticipate that to go lower. The components of net interest margin being yield on earning assets and cost of funds. We've seen the yield on earning assets continue its decline from the third quarter of 2019, and we see it's down to a 4.48. We expect this number to continue to creep down as we see the rates remain at these historically low levels. And the cost of funds comes down to 86 basis points. We still have room to move down on the cost of funds, but the big question is, will the cost of fund reduction be able to generate enough of a benefit that it will offset the yield on earning asset decline? And I think as we move forward that that's not going to happen. We're going to begin to see even more pressure on that margin and see that margin come down. As for the cost of interest-bearing deposits, we've seen this move down close to 1% at 1.06, and we should continue to see this number be reduced because if you recall last year we were writing a lot of higher rate 1 and 2 year CDs. So as those roll off the books, we should begin to see this come down at a faster pace. And I know most of the banks that we deal with are in that process of reducing down all of those non-maturity deposit rates or the cash type deposits. So these cash type deposits continue to grow as a percent of total deposits. Look where we are, back up to 72.03. And this has been a big push up. We're going to see in the second quarter numbers when they come out in August, we should see this number continue to climb, particularly with those PPP loans and those distributions of the PPP loans flowing into the deposits. So we should see this number continue to go up. And like I said, These are the low-cost deposits, particularly now with most of these deposit interest rates being reduced in April and May. When we look at the non-current loans, we can see a little bit of a pickup, just 3 basis points, moving up to 0.56. Obviously, with the economy in the position that it's in, we anticipate this number to continue to creep up. Likely what we'll see, not really in the second quarter, we'll see an increase, but in the third and fourth quarter, we will anticipate higher levels of non-current loans. And that's going to, push that into the question of a credit cycle and if we're going to see the overall net charge-offs. And later this quarter, we're going to look at that in more detail in a briefing. In terms of net overhead, we've seen the efficiency improve year over year. We've seen the overall level of net overhead come down to 2.07. If you recall, sub 2% is where we like to see institutions, but when we get into a very highly efficient institution, you're looking at about 1.75 or below. So we still have a ways to go to get the benchmark down to that level. Looking at the components, non-interest expense and non-interest income, we see a decline in non-interest expense as well as a decline in non-interest income. The issue with non-interest income is the fact that we have a lot of the overdraft protection monies that were coming for fees, that pulling off, and the loan sales also pulling off, pulling out that income. As far as expenses, we would anticipate some of the expenses to increase a little bit as we, transitioned over to the more online component and drive-through and the additional processes we had to put in place for the COVID shutdown. When we look at tax burden, we still continue to maintain on the stock group around that 20%. We did see the group, the mutual institutions, come down a little bit down to that 12% level for the effective tax rate. That could be a function of the number of filers as well. In terms of total risk, we have the risk picking up just a little bit in terms of the total risk for banks in this group. And we can see that being the cause of, we have the earnings at risk creeping up, as well as a little bit of a creep up in the credit risk. And we'll talk about those two in the future when we look at the impact of the charge-offs that will have on capital. And I think you'll be interested to see that today we're in a much better position to weather a credit cycle than we were back in 2008 prior to the Great Recession. But overall, that's what we have for you today. We look forward to talking to you again next week when we explore the second release of the first quarter GDP that's coming out, as well as where interest rates are and the impact that these low interest rates could have on your net interest margin. Have a great day, and we'll see you next time.